With Fed Chair Powell's speech in Jackson Hole now behind us, and the S&P 500 still hovering near all-time highs, the obvious question is, will this become a classic sell the news event, especially as we enter September, which of course is no volatility, and with the Fed meeting actually happening, all eyes will be on the reaction. So today we're going to go through a host of charts, both within the S&P 500, crypto, and other key ETFs to answer that question. So even though the S&P has been making new highs, there are, of course, some divergences in place. We talked about this in a daily perspective, but it's also happening on the weekly charts as well. So, of course, we're referring to the S&P 500 and the 14-week RSI. So, with the index already having made new all-time highs over 2 months ago, you would think that the indicator will be pushing through the 70 level, which, of course, is overbought. We saw how quickly it happened in early 2024 off the lows. They stayed there for a number of months, and even as the market came off, kept revisiting the zone near overbought territory, right? So this is an obvious bearish viewpoint, especially for traders that have that bias, and it can't be denied. The S&P is up more than 30% from the lows already, with many areas up much, much more than that. So the question is, why is it not there yet? And is it really a bearish sign? So let's zoom out to include 2020, because this most recent advance has been compared to the COVID crash and historic comeback for various reasons. We talked about it as well because of the historic pivot after the crash-like activity, which took the S&P back above new highs and continuing higher. As we know, at the very beginning, it was just the strongest response you could have asked for, whether that was short covering or people just clamoring for cheap stocks at that point. It produced a massive rally, again, taking the S&P back above new highs and then some. In 2020, obviously even more historic, dropping over 35% in 5 or 6 weeks, the biggest decline in that period of time in many, many years. And then, of course, the slingshot higher, which took the S&P back above those previous highs by the summer. Also, that took the 14-week RSI from being overbought to very oversold. Now, even though the S&P wasn't overbought right before the market fell apart, the ensuing downturn did produce the lowest 14-week RSI reading since the COVID lows. But even with the S&P ripping higher and overcoming its highs by the summertime, its 14-week RSI did not hit overbought territory officially until April 2021. So we're talking 13 months later, after the index was up over 90% at that time. We couldn't really rely on negative divergences to tell us that this market was about to roll over, which of course is the same story now. Now, it's not apples to apples because, as we recall, or as we know, the pullbacks along the way so far have been extremely small, right? Just 3.5% if we measure from intraday high to intraday low. We've had 2 of those so far in May and in August, where if we go back to what happened from the COVID lows, volatility stayed with us for a much longer time. As we know, initially we had that big 5.9% decline on June 11th, 2020 that produced a peak to trough decline of nearly 10%. And then in September and October, we had those back-to-back corrections as well. And so that were some reasons why the RSI couldn't get back up to overbought territory. At the same time, that did not slow down the locomotive that continued, as we know, until the very late stages of 2021. And so one of the questions is, well, what could change course with this? What could prevent the S&P from even getting back to overbought territory on a weekly basis? Well, a lot of that has to do with breadth, and that's been getting a lot of focus recently. And we go back over the last 21 days. From the last time the S&P hit its high in late July, remember, that was after a winning streak that extended to 6. There's been 21 trading days since that point. There's been 8 times when the S&P had positive breadth, but that means that 13 days actually have been negative. So over the last, say, month or so, the advantage has been to the bears from an internals perspective. And we can see that here on the S&P 500 and its cumulative advanced decline line on the bottom, with both of them kind of hovering near their most recent highs. And again, this is what's happened since that July 28th date here, where both of them getting close to making new highs, getting close to breaking out, but not quite being able to do so. And so in terms of using the cumulative advanced decline line as an indicator, it really doesn't give us too many glaring divergences along the way. This is going back to, again, late 2020. And for the most part, these tend to move together. Now, there have been instances when things have diverged. Most recently, in 2022, we know that the bear market was with us for most of that year. But at the same time, from even the January high through October, the cumulative advanced decline line was moving sideways. In fact, we'll recall that it made a marginal new all-time high as the S&P was going through one of its sharpest bear market rallies in the summertime. That got a lot of people bullish, of course, which was wrong because the market then endured one of its biggest rollovers since that point. We had to wait, as we know, until October for that to come. If we go all the way then back to the late 2024, we remember that December started with 14 consecutive negative breath days for the S&P 500 as the index itself was hovering near new highs because of its larger cap growth components doing so well. And that eventually led to the market being unable to capitalize on some of these bullish patterns, on making new highs, which eventually rolled over. The interesting part about this time from February to April is that the advanced decline line itself didn't really do much, right? It endured much more of a pullback during that December timeframe when, again, most of the field or the non-growth sectors were experiencing a lot of pain. But most of those areas, even though they went down with the whole market, we saw enough rotation into those other areas for that advanced decline line actually to hold up and made a new high a few weeks before the S&P 500 did. And since that point, both the AD line and the S&P 500 itself have been moving higher. So what does it really tell us here? Well, ultimately, the AD line does provide important clues about what's happening beneath the surface, which we wrote about this morning. When most of the field is struggling, the index can still advance for a while. And eventually, though, if that happens for long enough, the biggest names will catch down to the field. That could eventually pull the market lower. We've seen this time and again. It was extremely prevalent during the tariff-induced sell-offs. Now, in terms of NASDAQ breadth, as many of us know, the NASDAQ advanced decline line has been moving lower basically for 50 years. And so there's been plenty of negative divergences along the way with this one, and we can't rely on this for that particular reason, as we know, because the NASDAQ has done pretty well over the last half century to not trust it. But at times, it does give us some interesting insight. Number one, it doesn't fall all the time. And when the market overall is doing very well, the most speculative, the smallest names that exist within the NASDAQ, of course, come along for the ride. And that has been the case, no surprises, since the April low. But along the way, it just topped out. For the end of July, right when we were talking about the S&P 500's breadth starting to shift. And so it hasn't knocked down the NASDAQ yet. You know, it's been moving higher, making slight higher highs and higher lows. But if you go back to the last few times this occurred, a few things become clear. Is that, again, we've seen it in bear markets and bull markets here. But if we look closely, when this advanced decline line has topped, it has at least led to some short-term digestive periods, or sometimes even more, bigger corrections like we saw in late 2023. And of course, after that bear market rally in 2022, even in 2021, we had that initial pullback in the early stages with the S&P and the NDX and NASDAQ continuing higher. But some of those other names, like we find in ARK, of course, still trying to come back, haven't made new highs since that point. If we pull this back even further, the same type of thing in 2014, and again, right before the S&P 500, fell apart in late 2018. We're looking at NASDAQ here, but it really has to do with broader indices overall, whether that's the NDX, NASDAQ, S&P 500, Russell 2000, so forth and so on. We know when there's market volatility, there's not many places to hide. And so this just tells us maybe to take a pause here, right? Because we have the bigger names still hovering near their highs. And if we do get that volatility in September, we know that those will be some of the ones that could endure some pain. And of course, that happens, then the entire market would be at risk. So we kind of stated that here as well, right? If the latest peak has only resulted in a slight pause so far, but if the AD line continues to roll over like this, it could signal even more digestive action ahead for the NASDAQ, S&P 500, so forth and so on. So let's talk about patterns next. But first, this. I'm excited to introduce CappNotes, our free Substack newsletter, where we provide timely market commentary, trade ideas, and access to select premium content. Sign up today and receive our 6-step trading process that powers winning chart trades and limits losses. This is a simple, proven framework for spotting high probability setups. Simply go to cappnotes.substack.com, hit subscribe, and we'll send that guide directly to your inbox. Okay, so in terms of the patterns, we currently have 3 live bullish formations in play. 2 of them we talk about all the time. They've been live since the middle of May. Most recently, though, we got a breakout on August 12th, just about 2 weeks ago, which we can see much better on a 2-hour chart. And that one has been tested numerous times already. Considering that it's within 3% of achieving its target and just about 1% above the breakout zone, this will either be negated or considered an successful pattern. So how do we look at this? Number one, it's a very small pattern. So if it gets negated, not the end of the world, but it does give us some clues about breakouts potentially not being rewarded. Remember, that was a first sign of things changing in early December. We had a very small pattern, very similar to this one, fail. That led to then 2 or 3 more bullish patterns failing to materialize and hit their upside targets through January and early February. And that's when things really started to crumble. Remember, the internals started to deteriorate, all that together, then forming bearish patterns. And then, of course, the bottom fell out. So this is just a potential, but it would be something that we can't ignore if it fails, especially if it leads to other smaller patterns failing along the way. The other ones still have a lot of room to back and fill. That's why having one short-term pattern not play out, not the end of the world. We just need to see more form and actually play out for these upside targets to remain in play, including 67.45. Now, with the S&P 500 still not being able to get back to new all-time highs and hit that short-term price target, there also is a potential bearish pattern we're continuing to watch. And we've shown these along the way, and you can basically group any one of these pauses as a potential reversal pattern, which haven't played out yet. And so at some point, one may. And if the S&P does pull back more to say 6,200, bounce and fail or something like it, we can call this a bearish pattern. So the next step will be, after completing it, seeing a downside break. And then the final step, of course, would be having a downside target hit, all of which we have not seen since this bear flag hit this target during the biggest downturn we've seen so far this year in early April. So one of the reasons why that hasn't occurred is that two-way volatility remains low. Right, so far through Monday, August 25th, we have so far 3 1% gains for the month, 1 1% loss, which, as we can tell, happened exactly in May and June, with the aberration being July when there were 0 1% gains or losses. Right, that's extremely rare and last happened in December 2019. So needless to say, it's been an extreme change of pace since February, March, and April, especially in March and April, with most of these gains happening right around the pivot, but then giving way to a much more consistent uptrend. And we can see this very clearly on the chart here. Again, this was at April 21st low. And why we highlight this is because that was the key higher low, right? Which set the stage for the breakout, one of the first breakouts that we saw that ended up having its target hit. To review, 2 of the key traits we rely upon to tell us if we're in an uptrend is, so a low frequency of 1% moves on an absolute basis, both up and down, but more 1% gains and losses. This is exactly what's happened so far. Had 12 1% gains in now basically 4 months, and only 3 1% declines. And just as important is that soon after these 1% declines happened, we almost immediately saw 1% gain. So that means just that the dips have been bought. And also look at where these dips or these big moves have happened, mostly after those intermittent pullbacks have occurred, right? And so just another indication of investors using any chance to buy any bit of weakness that we see, keeping this trend intact up to this point. So we see this in the GoNoGo trend as well. No surprises. This is, again, that breakout we saw in the middle of May. From that point, all of these momentum indicators, all the moving averages, whatever factors the go-no-go trend uses has been tilted higher. And along the way, we see that it eventually, this oscillator on the bottom has come off of overbought territory indicated by the red arrows and then bounced off of the neutral zone indicated by the green dots, just showing again that we remain in an uptrend. So this is all very important information that we'll continue to use to complement the pattern work. And on a weekly basis, we're now on a week 10 of being in an uptrend, according to this indicator. And as we reviewed in the past, we've seen this act in a very similar manner. In previous times, the market has come back from big volatility events with the weekly indicator needing a lot more evidence of things turning. But once that does happen, it is tending to lead to many more weeks and months of uptrending action. So far, that has happened once again. And so let's look at a few charts outside of the S&P 500 now. And we're going to start with MSOS Cannabis. As you know, has come back in a huge way. And so let's look at this first by the pattern work. And we first identified this pretty clear double bottom formation as it was happening. Finally got the breakout. It went back and forth a little bit from this breakout zone, finally held, and within a few days hit that target and then some. And at that point really was a big test. You know, what was going to happen after a big spike like that? Best case scenario, we'll be seeing what? Higher low develop into another bullish pattern. Now, there could have been a cup and handle pattern, inverse head and shoulders pattern, but so far it looks much more like a bullish flag. And over the last few days, that bullish flag has been attempted to be leveraged as well. And if it can be, then we have a target all the way up at 7.2. Now, again, the numbers are small, but the percent moves are huge, right? And so the next part is zooming out to see what this looks like now, going all the way back to when this ETF began in log scale using the 40-week moving average, which is pretty much in line with the 200-day. And so once more, it's above this moving average and it's starting to curl higher. That's a positive sign. Now, of course, you all remember how many times we've seen this in the past. Now, it didn't get back above this line too many times, but it has attempted to turn like this before. We saw it in late 2022. It lasted for not even a week. But more recently, it gave us some very constructive looking action from a technical basis, getting back above this line 3 different times here, all of which it failed. When that last one failed at the beginning of 2024, that's when things really fell out of bed. And really, no one wanted to look at this after that because this looked really encouraging. We were talking about on our pieces as well, looking at the different bullish patterns that were forming. None of them got the necessary follow through that we needed. So now, because of that, and because we have recency bias, a lot of people still want to stay away from this. But there's one angle that makes this look extremely different. And that is looking at this on a weekly basis using the 9-week rate of change. And this looks at the last few days, but at its height through last Friday, we're up about 135, 136% over the last 9 weeks. And we can see how much bigger that is compared to even these rally attempts, right? Which capped out at 50%. So we're talking about a 9-week rate of change that was more than double what we saw, even close to triple the amount that we saw during these failed attempts here. So that just shows that there's something going on. Whether it's political or not, it just shows that things are different here. And that could really, and it has so far, kickstart momentum in the opposite direction, with MSOS now having a lot more leeway to potentially even drop back down to its breakout point around 3.2 or so, and then form another higher low. Hopefully it doesn't need to do that, but the next test here is going to be that 6 area, right, where the last bearish breakdown area came from, which is clear resistance. So if it can do that, if it can get through this area, continue to leverage the bullish flag breakout, and eventually get through 6, then of course we can talk about having much bigger patterns potentially being formed. So let's turn to Bitcoin. I think everyone knows by now the 110, 109 area is extremely important, right? It was the last breakout zone that we saw in July. It was also a new all-time high. And it's now very key support. As we can tell, same spot, which then looks like if it doesn't hold, this could be a pretty nasty looking topping formation. Again, pretty cut and dry. So another reason why this is very important is because, Bitcoin and the S&P 500 tend to move together, not in lockstep every single day, but when one has a lot more weakness than the other, it's very rare that they move in opposite directions for long periods of time. And so going back to January, Bitcoin topped in the middle of the month. The S&P 500 hovered for a bit before rolling over as Bitcoin continued to roll over, which looks very similar to now so far, with the S&P 500 again making a new high around the same time that Bitcoin did, with Bitcoin now having sold off 13% from the high, with the S&P still hovering, right? So best case scenario is that we do see a bid near 109, 110, which prevents that bearish pattern from being completed or worsening. Of course, worst case scenario is if that doesn't happen, Bitcoin then tends to roll over. It's going to be very hard for other risky assets to hold in there if Bitcoin itself, sells off in a meaningful way. And we can see this on a very long-term chart as well. We know that Bitcoin itself is much more volatile than the S&P 500, but directionally, they've moved together since really this chart shows in 2016. And lastly, XLK Technology. Of course, a lot will be riding on NVIDIA's report on Wednesday of this week. So this chart may look a lot different, better or for worse. Now, one thing that to keep in mind is that we've seen this uptrend line measured by, again, that higher low, which I think is a better starting point for anything here. But if we use that as a starting point and connect the most recent highs or most recent higher lows, then over the last few weeks, XLK now has undercut that line. Now, at some point, we knew that was going to happen. The pace can continue. In fact, this isn't the first uptrend line that it has undercut. It is the third one. So again, the pace has slowed from the beginning stages, slowed again, slowing again. And so what could happen is XLK just may have to endure more digestive action. And that could mean it has to pull back more than it has. It still has a cushion to do so above its last highs. This wouldn't feel great coming back down to say 240 or so, but it's earned that right to at least take a breather. And, from a positive perspective, that could then end up forming the next, set of bullish patterns as well. So another negative is that as it was making a new high in July and August, guess what was falling apart? The RSI. So that was a clear negative divergence in momentum once more. And it looks like it's played out, at least to an extent, because it's dropped back down to the 50-day moving average. And people who see this be like, well, it's back to that 50-day. If it rolls over, then it's going to look more like this, right? Which is a topping formation. Looks like a classic potential head and shoulders pattern. We've seen that before. In fact, another key trait of an uptrend is, as we know, not only bullish patterns working, but bearish patterns failing. And so if this momentum shift is going to get much more severe, we will see it and eventually bearish patterns like this not only getting completed, but seeing them roll over. And really our bias, how we view the market, is revealed in how we see these patterns. We did a whole video about it, which you can check out right here.